What's notable was what was absent in her speech. A couple of expressions of worries about international development, but nothing serious. Why is the Fed downplaying overseas risks?
Because the U.S. labor market is continuing to plow through international developments. I mean, these are all tail risk. At some point, if the labor market continues to do what it's been doing, which is steady job growth in excess of 200,000, I don't know. I mean, you kind of have to wake up and say maybe these downside risks shouldn't be penciled into the baseline outlook. I think an interesting example is 1998, right? I mean, then, like now, unemployment was low, payrolls were rising at a good rate. Then, like now, inflation was low, and then, like now, Asia was in a financial crisis. There was concerns around the global economy. And what did the Fed do? They actually eased during that time. The labor market was still tightening. There was no change in the underlying economic outlook here in the United States, and ultimately the Fed had to raise rates 175 basis points from May 1999 to May 2000. So, I think policymakers should learn from past mistakes, and my sense is that the balance of risks is shifting, and I think the cost of leaving rates at zero here are rising relative to the benefits.
Yellen doesn't seem to think we're at full employment here. She has a problem with labor participation. She has a problem with
wage growth.
What do you think?
No, there's no doubt that she does. How
do you think differently than she does?
Well,
I mean, it would look to some other observers as if we are doing pretty well on the employment.
Well, I think really it's a debate between someone like John Williams at the San Francisco Fed and someone like Charlie Evans at the Chicago Fed. Someone like John Williams versus something like the IMF, right? And I think Yellen kind of falls somewhere in the middle. I think the debate really is over one rate hike or two rate hikes this year. And I think Yellen probably was at two before June. But if the data continues to improve, as it has been since the middle of May, then Yellen can adjust that assumption and bring it forward to September. Where do we see things differently? I think the labor force participation rate at best is going to stay flat as demographics continue to put downward pressure on it, but you have some rebound in people coming back in, so it kind of stays flat. In terms of wage growth, I think that's going to move from tentative, in her words,
yes,
to definitive by the end of the third quarter.
Does that show up in average hourly earnings, or does it show up in other measures that perhaps she's not emphasizing when she uses the word tentative?
Well, I think, average hourly earnings has been depressed for a long time now, and it really is the outlier. If you take a look at all the labor market indicators of wages, so compensation per hour, employment cost index, something from the Atlanta Fed, median hourly wage growth, all of this is pointing to something closer to 2.5 to 3. So, and remember, this is also happening at a time when productivity growth is pretty weak here in the United States. And Yellen kind of made that point at the end of her speech, kind of in passing. If compensation is rising close to 3% and productivity is 1, maybe less, that tells me that companies are likely to raise selling prices over the next several months to defend those margins, and that's going to boost up inflation.
In that case, it would seem that a stronger dollar is an even more serious threat. Do you think she's thinking, look, 18 central banks around the world are still in some sort of quantitative easing phase, and I'm raising rates, all the capital is going to rush to the higher rate?
Well, I think the Fed has been seeing that for a while now. I mean, remember, in their year-ahead outlooks back at the end of last year, they basically said that one of the ways that central banks globally would be responding to the decline in oil prices would be more accommodative monetary policy, and because of lower inflation, and that's what we've seen. And at the same time, they were still guiding for rate hikes this year. So I think most of the increase in the dollar has been fully appropriate. I think you can make an argument that some of the increase from January to March was probably a bit overdone because the economy wasn't looking too good at that point. But I think going forward, we're probably going to be talking about the dollar more as a reflection of good growth here in the United States as opposed to some sort of an exogenous shock, which is the way they were kind of treating it back in March.